Do not adjust your screen. What you're about to hear is real. The price of silver did not rise today. It did not rally. It did not grind higher. It teleported. In a single trading session, silver moved in a way that is not supposed to happen in orderly markets. We are looking at a price that jumped more than 8% in dollar terms, in hours, not weeks. The screens in New York are showing silver trading near $78, while the physical market in Asia is already pricing something very different. This is not a chart pattern. This is not speculation. This is not retail hype. This is a breakdown in price control. Because, while New York celebrates $78 per ounce, Shanghai has already printed numbers the Western paper market is not ready to explain. $83, $85, and now reports confirming $87 in live physical transactions. That is not noise. That is a message. For weeks, the price of silver in dollar terms was suppressed relative to the rest of the world. The United States price was lagging. The COMEX price was discounted. New York was trading silver as if nothing had changed, while the rest of the planet was quietly draining supply. And today, the elastic band snapped. The United States price is now frantically chasing the global price. But even after this explosive move, even after an 8% jump in dollar terms, it is still behind, still discounted, still trying to catch up to a reality that is no longer patient. We just received confirmed pricing from the Shanghai Gold Exchange. While New York is trading silver near $78, Shanghai is transacting near $84 to $87, depending on form, delivery speed, and purity. That is not a rounding error. That is not a temporary premium. That is a $5 to $9 gap per ounce. In commodity markets, a gap like that is a magnet. And right now, that magnet is pulling prices higher faster than most people understand. Because every algorithm, every arbitrage desk, every global trading system sees the same thing. Buy where it is cheap, sell where it is expensive. And right now, in dollar terms, New York is cheap. This is why the move feels violent. This is why it feels sudden. Because it is not driven by emotion. It is driven by machines responding to a broken pricing system. Normal markets do not move 8% on a random weekday morning. Normal markets do not gap multiple dollars between continents. Normal markets do not force arbitrage desks into emergency buying. This is not normal. This is a liquidity vacuum. This is what happens when the paper market runs into physical reality. For years, silver was priced primarily through futures contracts, derivatives, and promises settled in dollars. Physical demand was treated as secondary, optional, delayed. But physical silver does not care about narratives. It does not care about Federal Reserve talking points. It does not care about dollar strength headlines. It only cares about availability. And availability is disappearing. For weeks, Asia has been absorbing physical silver at prices well above the Western dollar price. India, China, Southeast Asia, industrial buyers, state-linked entities, all taking delivery, all paying premiums, all draining inventory. Meanwhile, the COMEX continued to quote silver as if supply was endless. That illusion ended today. Because when enough physical silver leaves the system, paper pricing loses authority. Futures markets can only dictate prices as long as physical delivery is credible. The moment delivery becomes questionable, the dollar price becomes a suggestion, not a rule. This is why Shanghai matters. The Shanghai Gold Exchange does not trade imaginary ounces. Contracts there are backed by physical metal. When Shanghai prints a price, it reflects what buyers are actually paying in real dollars, converted into yuan for metal they can touch. So when Shanghai trades silver at $87, it is not predicting the future. It is reporting the present. New York, on the other hand, is still trading promises. And those promises are now being stress tested. Because arbitrage bots do not care about speeches. They care about spreads. They care about gaps. And right now, the gap between Shanghai and New York is screaming. Buy COMEX, buy futures, buy anything deliverable, close the gap. That is exactly what we're watching. Every contract that can be sourced is being bought to force convergence. And that buying pressure does not stop at $78. It does not stop at $80. It stops only when the dollar price aligns with physical reality. And physical reality is already higher. This is where the dollar comparison becomes unavoidable. Because silver is not just rising. It is rising against the dollar. Not slowly, not gradually, but violently. An 8% move in silver in one session is not just a commodity story, it is a currency story. It is a signal that the dollar price mechanism is under strain. For decades, the dollar has been used as the universal yardstick. Gold priced in dollars, silver priced in dollars, oil priced in dollars, everything priced in dollars. But what happens when the dollar-based price no longer reflects actual scarcity? What happens when the official price is cheaper than the real-world price? You get exactly this. A sudden, uncontrollable repricing. The media will try to explain this away. They will say it is volatility. They will say it is speculation. They will say it is a reaction to economic data, or interest rate expectations, or geopolitical headlines. But those explanations collapse under one simple fact. None of those things create a $9 regional price gap. Only one thing does: physical shortage. Silver is not a large market. It does not take much demand to overwhelm supply. And unlike gold, most silver is consumed. It is used in electronics, solar panels, medical equipment, military applications. Once used, it is gone. At the same time, mine supply has been flat to declining. New discoveries are rare. Production costs are rising. Environmental restrictions are tightening. And investment demand is returning at the worst possible moment. Because now, the dollar itself is being questioned. Every time silver jumps in dollar terms, it sends a message, not just about silver, but about confidence, about trust, about whether paper claims are still enough. Today's move says they are not. And Shanghai hitting $87 is the exclamation point. This is not the end of the move. This is the start of repricing. The market is not overbought. It is underadjusted. It is catching up to months of suppressed reality in a matter of hours. When prices move this fast, it is because they were wrong before. And they were wrong because control was artificial. That control is now breaking. To understand why control was lost today, you have to understand how silver was controlled yesterday. This market did not break overnight. It was bent slowly, quietly, and systematically through the dollar-based paper system. For years, silver has been priced not by what it costs to acquire physically, but by what it costs to settle financially. Futures contracts, options, swaps, and unallocated accounts became the dominant pricing force. These instruments are denominated in dollars, settled in dollars, and designed to give exposure without delivery. As long as people accepted dollars instead of metal, the system worked. But the moment physical demand overwhelms paper promises, the system destabilizes. And that is exactly what is happening now. The dollar price of silver in New York was never the global price. It was a reference price, a benchmark, one that assumed unlimited liquidity and infinite confidence. But benchmarks fail when reality diverges too far. Shanghai exposed that divergence. When silver trades at $78 in New York and $87 in Shanghai, that is not bullish sentiment. That is arbitrage failure. That is the market telling you the dollar price is obsolete. Arbitrage is supposed to prevent this. In theory, traders buy silver where it is cheap and sell where it is expensive, closing the gap. But arbitrage only works when metal can move freely and quickly, and that is the flaw. Physical silver does not teleport. It does not move at the speed of fiber optics. It has to be mined, refined, assayed, shipped, insured, cleared through customs, and delivered. All of that takes time. And when inventories are thin, it takes even longer. So while dollar-based algorithms see a $5 to $9 gap and scream buy, the physical market cannot respond instantly. That delay is where panic begins. Because during that delay, prices must rise. This is why arbitrage bots are buying every contract they can find. Not because they want silver exposure, but because they need deliverable units. They need optionality. They need a path to physical settlement if the gap refuses to close. And when too many entities want the same thing at the same time, the dollar price jumps violently. That is what you're seeing on your screen. The phrase panic buying sounds emotional, but in this case, it is mechanical. Systems are panicking, not people. Risk models are recalculating. Delivery risk is being repriced. Counterparty confidence is being stress tested. And the dollar is at the center of it. Every silver contract on the COMEX is priced in dollars. Every margin call is in dollars. Every settlement assumption is based on dollar liquidity. But physical silver demand is not dollar dependent. It is need dependent. China does not buy silver because the dollar index moves. China buys silver because factories need it. Solar installations need it. Strategic reserves want it. And they pay what they must to secure it. That is why Shanghai is willing to pay $87 while New York hesitates at $78. The dollar price is lagging reality, and that lag is dangerous. Because once confidence breaks, the adjustment is not smooth, it is abrupt. Holders of paper claims suddenly realize they may not be able to convert those claims into metal at the quoted price. That realization changes behavior instantly. Instead of selling rallies, they buy dips. Instead of rolling contracts, they stand for delivery. Instead of trusting the system, they hedge against it. Each of those actions pushes the dollar price higher. This is why today's move feels uncontrollable, because it is not driven by one buyer or one country. It is driven by a systemic shift in preference, from paper to physical, from promises to possession. And this is where the dollar comparison becomes unavoidable again. Silver priced in dollars is only stable when the dollar itself is stable, but the dollar is under pressure, debt levels are exploding, deficits are structural, real yields are negative, confidence is fragile. When the unit of measurement weakens, everything measured in that unit appears to rise. But silver is not just rising because the dollar is weakening. It is rising because supply is tightening at the same time. That is the dangerous combination. In previous cycles, rising silver prices were often driven by speculative flows. Traders betting on inflation, momentum funds chasing charts, retail enthusiasm. Those moves were sharp but temporary. This move is different. This move is driven by delivery stress. When Shanghai prints a price, it reflects immediate settlement. No leverage. No cash settlement alternatives. Metal changes hands. Inventory leaves vaults. When New York prints a price, it reflects expectations, probabilities, optional delivery. That difference matters more than ever, because optional delivery is only optional until too many people choose it. At that point, it becomes mandatory, and mandatory delivery exposes shortages. This is why control was lost today. The paper system assumed flexibility that no longer exists. It assumed that most contracts would be closed financially. That assumption is breaking down. As more participants demand physical exposure, the system has to adjust prices upward to discourage demand. That is the only lever it has. Raise the dollar price, and raise it quickly. This is why silver can move 8% in a single session. Not because 8% is rational, but because 8% is insufficient to restore balance. The market is searching for a price that slows demand and attracts supply. It has not found it yet. And Shanghai at $87 suggests that price is higher than many expect. The dollar-based system is now reacting, not leading. It is responding to signals from physical markets rather than dictating them. That is a reversal of control. For decades, Western exchanges set the price and the rest of the world followed. Now, Asia is setting the price and the West is scrambling to catch up. That shift has consequences far beyond silver, because silver is not isolated. It is connected to gold, to currencies, to confidence. When silver breaks free, it sends shockwaves through the entire monetary complex. Gold priced in dollars cannot remain stable if silver explodes. The two are linked by substitution, by investor psychology, and by industrial dynamics. A rising silver price pulls gold higher, especially when the move is driven by physical demand. And gold priced in dollars is a referendum on trust. This is why the dollar narrative is so important. Because silver is not just outperforming stocks or bonds. It is outperforming the dollar itself. An 8% gain in silver is an 8% loss in dollar purchasing power relative to silver. That is not a headline most people are ready for, and yet it is happening. Panic buying accelerates when people realize they are late, when they see prices moving without them, when availability disappears, when premiums rise, when delivery times extend. Those signals are already flashing. Retail buyers are seeing delays. Industrial buyers are locking in supply months in advance. Vault inventories are declining. Lease rates are tightening. All of this points to one thing: stress. Stress breaks systems. The dollar-based silver pricing system was built for abundance, not scarcity. It was built for confidence, not doubt. It was built for leverage, not delivery. Today, it is facing delivery, and delivery is unforgiving. The Shanghai premium is not just a number, it is a vote of where silver should be priced if dollars were not allowed to distort the signal. At $87, Shanghai is saying this is what it takes to secure metal now. New York has not accepted that yet, but it will, because arbitrage does not care about narratives, it cares about profit. And as long as the gap exists, buying pressure will remain relentless. This is why attempts to cap the price fail. Every time silver is pushed down in dollar terms, it becomes cheaper relative to Asia. That invites more buying, that drains more supply, that widens the gap again. It is a self-defeating strategy. Control only works when demand is weak, when people are indifferent, when alternatives are trusted. That is no longer the case. Trust in the dollar system is eroding, not collapsing overnight, but fraying at the edges. And silver is one of the first places where that erosion becomes visible, because silver sits at the intersection of money and industry. It is both a monetary metal and a consumable resource. That makes it uniquely sensitive to systemic stress. When confidence fades, people buy silver. When industry grows, people buy silver. When supply tightens, people buy silver. Right now, all three forces are aligned. That alignment is rare, and when it happens, prices do not move gradually, they gap, they teleport. And what you're witnessing is not the end of a move, but the exposure of a lie. The lie that paper prices can permanently override physical reality. The lie that dollars can always substitute for metal. The lie that control is absolute. Shanghai just disproved that. At $87, the market is telling you something important. Silver is no longer cheap enough to ignore, no longer abundant enough to suppress. The question now is not whether prices will adjust. The question is how violently. The most dangerous moment for any controlled market is not when prices fall. It is when prices rise faster than explanations can be written. That is the phase silver has entered now. When silver trades calmly, analysts talk about interest rates, inflation expectations, and economic cycles. But when silver explodes in dollar terms, those explanations disappear. Because this kind of move exposes something deeper, a failure of trust. Trust is the real currency behind the dollar system. The dollar itself is not backed by gold, it is backed by confidence. confidence that contracts will be honored, confidence that prices reflect reality, confidence that paper claims can be converted into something real if necessary. Silver is now testing that confidence. Every dollar-denominated silver contract represents a promise that metal exists somewhere, that it can be delivered, that the quoted price is fair. As long as people believe that promise, the system holds. But belief is fragile. Once participants begin to question whether that promise can be fulfilled, behavior changes immediately. They stop trading paper for profit and start trading paper for protection. That shift is what turns a rally into a rupture. This is why the word panic keeps appearing. Not because people are emotional, but because systems are repricing risk faster than humans can react. Risk models are being rewritten in real time. Margin requirements are tightening. Clearinghouses are watching inventories with increasing concern. Because silver inventories are not growing, they are shrinking. For years, the dollar price of silver discouraged production. Mining companies struggled to justify expansion. Capital expenditures were delayed. Exploration budgets were cut. At the same time, demand quietly increased. Solar panels require silver. Electric vehicles require silver. Data centers require silver. Medical technology requires silver. Military systems require silver. None of these buyers care about the dollar narrative. They care about securing supply. So they buy when they must. That demand was masked by paper pricing. The dollar price stayed low, creating the illusion of abundance. But the metal was leaving the system, and now the system is realizing it too late. This is where futures markets become vulnerable. Futures assume liquidity. They assume contracts can be rolled, offset, or settled without friction. But physical shortages introduce friction. When too many contracts point toward too little metal, prices must rise to ration demand. That rationing process is underway now. Every dollar increase in silver is an attempt by the market to slow buying, to make someone hesitate, to make demand think twice. But so far, it is not working. Because for many buyers, price is secondary to availability. Industrial buyers cannot substitute silver easily. There is no alternative metal with the same conductivity, durability, and efficiency. When supply tightens, they pay more. Strategic buyers think even longer term. They do not care about quarterly prices. They care about securing material for years. For them, $87 is cheap compared to not having silver at all. This is why Shanghai leads. Shanghai reflects buyers who want metal, not exposure. New York reflects traders who want exposure, not metal. When those two worlds collide, the physical market wins. And the collision is happening now. The dollar-based silver price is trying to catch up to a world that no longer accepts its authority unquestioningly. Each dollar increase is an admission that the previous price was wrong. And the higher it goes, the more attention it attracts. Because price is a signal. When silver jumps 8%, people notice. When it gaps multiple dollars above previous resistance, people ask questions. When Shanghai trades far above New York, people lose confidence in the benchmark. That loss of confidence spreads. Investors begin to question other prices. Gold, oil, bonds, currencies. If silver was mispriced, what else is? This is how systemic stress propagates. The dollar system depends on perception of stability. Small, orderly moves. Predictable behavior. But silver is not behaving predictably anymore. It is behaving honestly. Honesty is disruptive, because honesty reveals scarcity. And scarcity forces repricing. This is why attempts to dismiss this move as temporary are dangerous. Temporary moves fade quickly. Structural repricing does not. This move has structure, it has a cause, and it has momentum rooted in reality. Look at inventories. Registered silver stocks on Western exchanges have been declining for years. Vaults report outflows. ETFs lose metal even when prices rise because authorized participants remove silver to meet off-exchange demand. At the same time, premiums on coins and bars remain elevated. Delivery delays persist. These are not signs of abundance, they are signs of strain. The dollar price tried to ignore those signs. It failed. Now it is reacting. And reactions are always more violent than adjustments. This is why control appears lost, because control requires foresight. It requires anticipation. It requires proactive management. What we are seeing now is reactive. The market is behind the curve. Each spike higher is the system saying, we underestimated demand. Each pause is the system hoping demand will slow. And each new surge is demand proving it will not. This pattern is dangerous for shorts. Short positions rely on time. They rely on the ability to wait. They rely on stable margins. They rely on predictable volatility. When volatility explodes, shorts are forced to act. They buy to cover. That buying adds fuel. And when shorts cover into thin liquidity, prices gap. This is why silver moves feel explosive rather than smooth. The market is thin, liquidity is poor, and urgency is high. The dollar price is no longer a calm reference point. It is a battleground. Every uptick pressures someone. Every downtick invites buying. The balance is unstable, and instability favors higher prices. Because fear of missing out is stronger than fear of overpaying when supply is uncertain. This is especially true when the unit of account, the dollar, is itself under scrutiny. The dollar has enjoyed reserve status for decades. That status allowed the United States to run deficits, print currency, and export inflation. It also allowed commodity prices to be managed through financial instruments. But reserve status is not a guarantee. It is a privilege granted by trust. When trust erodes, alternatives gain appeal. Gold is one alternative, silver is another. Unlike fiat currencies, silver cannot be created with keystrokes. Unlike bonds, it does not default. Unlike stocks, it does not depend on earnings, it simply exists. That simplicity becomes attractive during uncertainty. This is why silver often lags gold initially, then outperforms dramatically. It is smaller, thinner, and more volatile. When capital flows shift, silver responds violently. What we are seeing now fits that pattern. Gold has been rising steadily in dollar terms, signaling currency stress. Silver lagged, held down by paper mechanisms. Now silver is catching up, and catching up quickly. The Shanghai Premium confirms that silver was undervalued in dollar terms. It confirms that the Western price was an anomaly. Markets do not tolerate anomalies for long. They correct them, and corrections are rarely polite. The panic buying you are witnessing is not the endgame. It is the beginning of recognition. Recognition that silver is not where it should be priced relative to the dollar. Once that recognition spreads, behavior changes permanently. People stop waiting for pullbacks. They stop trusting dips. They stop selling into strength. They buy and hold. That shift removes liquidity from the market. And low liquidity amplifies volatility. This is how explosive moves sustain themselves, not through hype, but through structure. This is also why official explanations will feel hollow. Rate hikes, CPI prints, employment data, none of these explain why Shanghai trades $9 above New York. Only one explanation does: physical scarcity. And physical scarcity does not resolve quickly. You cannot print silver, you cannot accelerate mining overnight, you cannot recycle consumed metal instantly. Supply responds slowly. Demand, on the other hand, responds immediately to fear. Fear of shortage, fear of devaluation, fear of being last. That fear is rational, because history shows that when metals reprice, they do not ask permission. They move until equilibrium is restored. And equilibrium is not a price on a screen. It is a balance between available metal and willing buyers. Right now, that balance does not exist. Shanghai is telling you the truth. New York is catching up, and the dollar is caught in between. Every dollar increase in silver is a reminder that paper systems are fragile. Every premium is a reminder that physical reality matters. Every delivery request is a test of confidence. Some systems pass those tests quietly, others fail loudly. Silver is forcing the test now. And the outcome will not be decided by opinion, analysis, or forecasts. It will be decided by inventory. Every market eventually reaches a moment where it can no longer pretend, a moment where the stories stop working, the explanations sound recycled, and the numbers on the screen begin to contradict the lived reality of buyers and sellers. Silver has reached that moment. What happened when Shanghai hit $87 was not a spike. It was a confession. A confession that the global silver market has been mispriced in dollar terms for longer than most people realize. Markets can hide imbalance for a long time, but they cannot hide it forever. When imbalance becomes too large, price becomes the messenger. And the message silver is sending now is unmistakable. The dollar price was wrong. For years, the global financial system relied on the assumption that silver was abundant, liquid, and easily replaceable. That assumption allowed it to be treated like a derivative instead of a resource. Contracts multiplied. Leverage expanded. Paper claims grew far beyond physical reality. As long as nobody asked for the metal, this worked. But history shows that systems built on assumptions fail when those assumptions are tested. And silver is now testing them all at once. The dollar-based pricing model assumed that physical demand would remain passive. It assumed that industrial users would accept any price dictated by futures markets. It assumed that investors would prefer exposure over possession. And it assumed that trust in the dollar would remain intact. None of those assumptions are holding anymore. Industrial demand has become strategic. Investors are becoming skeptical. Physical buyers are refusing to wait. And trust in paper systems is eroding at the edges. This is not collapse, it is transition. And transitions are volatile. The most important thing to understand is that silver's move is not isolated. It is connected to a much larger shift in how value is measured. For decades, the dollar served as the unquestioned unit of account. Everything was priced through it. That gave the illusion of stability. But stability based on confidence only lasts as long as confidence does. When confidence weakens, people look for anchors, assets that do not depend on promises, assets that do not require belief. Silver is one of those anchors. It is imperfect. It is volatile. It is inconvenient. But it is real. That reality matters more now than it has in a generation. The price difference between Shanghai and New York exposed a fracture in the system. It revealed that the dollar price is no longer authoritative. It is reactive. It follows physical demand rather than leading it. This is a fundamental change. Once markets accept that physical pricing leads paper pricing, behavior changes permanently. Traders stop assuming that dips will be engineered. They stop assuming that volatility will be suppressed. They stop assuming that control is guaranteed. And when those assumptions disappear, markets reprice risk aggressively. This is why silver's move feels abrupt, because risk was mispriced before. The dollar price reflected confidence, not scarcity. It reflected leverage, not limits. It reflected consensus, not truth. Shanghai reflected truth. At $87, the market is telling you what silver costs when demand is immediate and supply is finite. That price may fluctuate. It may overshoot. It may correct. But it will not return to pretending scarcity does not exist. That illusion is gone. The question now is how the system adapts. Some will try to dismiss the move as temporary. They will point to technical indicators, to historical averages, to positioning data. They will say silver has gone too far, too fast. But markets do not care about comfort. They care about balance, and balance has not been restored. The physical market is still tight. Inventory remains constrained. Delivery timelines remain extended. Premiums remain elevated. These are not conditions that support a rapid reversal. At the same time, the dollar faces its own pressures. Debt expansion is relentless. Monetary policy is constrained. Fiscal discipline is absent. Confidence is being maintained, not rebuilt. In that environment, metals do not need hype to rise. They only need doubt. Silver's rise is not about optimism. It is about insurance. It is about opting out of a system that feels increasingly abstract. This is why comparisons to previous cycles fall short. In past bull markets, silver rose alongside confidence. This time, it is rising alongside skepticism. That difference matters. Skepticism does not reverse easily. Once participants begin to question the integrity of pricing mechanisms, they do not return to blind trust. They become cautious. They demand proof. They prefer possession. The preference removes liquidity from the paper market. And low liquidity means higher volatility. The market will attempt to regain control. That is inevitable. Exchanges will adjust margins. Regulators will monitor flows. Commentators will craft narratives. All of this is part of the process. But none of it creates silver. None of it increases supply. None of it shortens delivery timelines. Those constraints remain. And as long as they remain, price must adjust. Not because someone wants it to, but because the system requires it. The idea that silver is too expensive at $87 assumes a baseline that no longer exists. Expensive relative to what? To a dollar price that was artificially low? To a historical average that ignored consumption? To a futures market that assumed endless rollover? Those comparisons no longer apply. The relevant comparison is between demand and supply, and demand is winning. It is also important to understand that silver does not need mass participation to move. It is a small market. Incremental demand creates outsized effects. A few large buyers can drain meaningful inventory. This makes silver uniquely sensitive to shifts in sentiment. When sentiment shifts from indifference to urgency, price does not glide. It leaps. That leap is what many are mistaking for panic. But panic implies irrationality. What we are seeing is rational repricing. Rational repricing feels chaotic when it happens quickly. The dollar system was designed to smooth volatility, to distribute stress, to delay consequences. It has done that successfully for a long time. But delaying consequences does not eliminate them. It concentrates them. Silver is now releasing years of concentrated imbalance. That release is uncomfortable. It challenges assumptions. It exposes vulnerabilities. And it forces a reevaluation of what price actually means. For decades, price meant consensus. Now price means availability. That shift has implications far beyond silver. If physical markets begin to override paper markets consistently, the architecture of pricing changes. Benchmarks lose authority. Regional pricing matters more. Delivery terms matter more. Trust becomes localized. This is already happening in energy, in food, and critical minerals. Silver is simply one of the clearest examples. The reason it is so visible is because it sits between finance and reality. It cannot be fully financialized, and it cannot be ignored by industry. That dual role makes it a stress indicator, and right now that indicator is flashing. Shanghai hitting $87 is not the peak of the story. It is the data point that confirms the story is real. It confirms that the Western price was out of alignment with global demand. Alignment is now being forced. The dollar price will continue to adjust until the incentive to arbitrage disappears, until it no longer makes sense to buy in one region and sell in another, until physical flows stabilize. That could happen at higher prices. It could happen through time. It could happen through reduced demand. But it will happen. Markets do not tolerate persistent gaps. What makes this moment different is that the gap exists not just between regions, but between systems, between paper and physical, between promises and possession. That gap cannot be closed by commentary, only by metal. This is why watching inventories matters more than watching charts. This is why premiums matter more than spot prices. This is why delivery matters more than volume. The signal is not in the candles, it is in the vaults. And the vaults are quieter than they used to be. As this process continues, volatility will remain elevated, pullbacks will occur, rallies will overshoot. That is the nature of repricing. But the underlying direction is set by fundamentals. And the fundamentals are tight. Silver does not need to become money again to justify higher prices. It only needs to remain necessary. And it is. Every solar panel installed, every data center built, every medical device produced, every electronic system upgraded consumes silver. That consumption is permanent. At the same time, the investment narrative is returning, not as speculation, but as diversification, as hedging, as insurance. That combination is powerful. Consumption plus protection. Few assets sit at that intersection. Silver does. That is why it is moving now. Not because someone decided it should, but because conditions made it inevitable. The dollar-based system will adapt, as it always does. It will find new ways to manage volatility, to spread risk, to maintain confidence, but it will do so at a higher price level, because prices cannot go back to pretending scarcity does not exist. Shanghai has already moved on. The rest of the world is catching up. What comes next will not be smooth, it will not be linear, and it will not be comfortable for those accustomed to control, but it will be honest, and honesty in markets is disruptive. Silver is no longer whispering that something is wrong. It is stating it clearly, in dollars.